Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 8:15 on Monday morning, July 28th. That's Mountain Time. Our note this week was titled Macro Investing Super Bowl Week. As we considered all of the macro events due this week, it just struck us as we're hard pressed to find a week with more important and interesting events. Treasury financing, employment week, the second quarter GDP number, which we think is going to confirm that growth is not so solid, obviously a Federal Reserve meeting, and some of the big tech Gen AI boom beneficiary earnings this week as well. So it's going to be super exciting. So here's the bottom line first. We probably the newest theme from an investing perspective we introduced this week was our idea that the 10-year Treasury could break the 460, 430 range on the downside, meaning higher Treasury prices. We are not in the camp that the reason that 10-year Treasury yields went up a percent last year in the fourth quarter when the Fed was cutting a percent was the Fed. This is equivalent in our view of the sun doesn't come up because the cock crows. What happened in the fourth quarter of last year, and you could see it clearly in things like inflation breakevens, which went down. It wasn't the Fed and concerns about inflation that drove bond yields up. Initially, it was some stronger data, some of which we think was kind of dubious, like the September employment report. But then it was swap spreads getting much more deeply negative, suggesting that the issue was expected supply related to the presidential election and two candidates promising policies that at the time were both perceived as likely to increase the supply of treasuries. We'll see whether that's actually going to happen and learn more about that this week. But the Harris administration policies clearly would have created more supply of treasuries. That's why rates went up. So we know you're going to hear a lot about this. If the Fed makes it clear, as we expect, that they're on the verge of starting another rate cutting cycle, you're going to hear a lot of people say, well, that's going to drive treasury yields up. We just think that that is completely wrong. So that's position number one. Number two, we are long financials, and we discuss small banks versus big banks in the note. Be a full subscriber, you can get all the details on that. We are long Germany, Japan, and China via emerging markets, and this is a key sort of theme and point of differentiation. We heard Ed Yardeni discussing it this morning with the Squawk crew. The reason that the markets are higher, including the US market, is because ultimately this rebalancing of global trade will force these economies that have been a huge drag on the world, the export-dependent economies, with policies that were impairing dynamism, impairing innovation in their own economies, meaning Germany and Japan. For the last 50 years, we've been fighting with them about this. And China more recently as our major protagonist. Their mercantilist policies are impairing global growth and innovation. And so we always thought the Trump administration's policies would force them to restructure their economies away from this export dependency. And ultimately, that would be a force for good, not bad. And we think this is what the markets are saying, not the markets are wrong. Markets we actually think are right. And that's why we've been long these markets since even before Liberation Day. So we're going to get Treasury financing news this afternoon. It should be quite interesting about their total financing needs. They have to integrate the effects of the One Big Beautiful Bill Act as well as tariff-related financing, and maybe they'll just take a guess and say it'll remain unchanged. But nonetheless, that should be interesting. This is also Belly Week. They're auctioning 2s, 5s, and 7s this week. They're condensing it into 2 days, today and tomorrow, ahead of the Fed meeting. On Wednesday morning, we're going to get GDP. It's going to show us that growth is not so solid, which was part of the initial current conditions, part of the communique or the Fed statement. We're going to get a employment cost index number. We're getting employment week. We're going to put out a payroll preview note on Wednesday after the Fed meeting, which will include our initial thoughts on that Fed meeting. And we would, in essence, continue to underweight the consumer related sectors, staples, and consumer discretionary, overweight the broadening out of CapEx beneficiaries. So that's industrials, materials, and energy. We remain with healthy positions in tech and communication services, riding the AI bubble. We shouldn't call it bubble, the AI investment boom wave. We'll see if it turns into a bubble. We're not ready to make that assessment right now. Other things, important things in the note, we did go through the Fed meeting in great detail. We would also note there is the new tenant index was released by BLS last week, which is going to continue to put very strong downward pressure on inflation throughout the back half of the year. And earnings season thus far is very weak outside of tech and communication services. Financials had a decent quarter, particularly the big banks, but it implies weak demand and margin pressure related to tariffs. And so growth is not solid, employment is not solid, the economy is going through what Treasury Secretary Bessent called a detox from our addiction to government spending. We called cleaning up the industrial policy mess. The Fed should be trying to facilitate this transition, not leaning against it. And that's bottom line. But we do think the net effect of this week's meeting, press conference, and post-meeting speeches will be relatively dovish, and it will be a catalyst for tightening of mortgage spreads and stronger Treasury market performance. She should be along the belly of the curve. Barry Neff from Ironsides. Have a good week, everyone. Thank you.